This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 47. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review the Planet MicroCap Podcast on iTunes. It really helps provide feedback for me and spread the MicroCap message. For this episode of the Planet MicroCap Podcast, I spoke with Denis Amato from Ancora Advisors. I recently met Denis while organizing the Planet MicroCap Showcase, and he sent me his firm's investment letters to read. I thought they were really quite insightful on microcap investing, and there was one letter in particular that caught my eye, and it was a paper they published in October 2014 called, and I quote, MicroCap Myths. We've touched on this topic a couple of times, especially when it comes to mainstream media's portrayal of microcap stocks, well, penny stocks, and I thought this would be an interesting topic to cover in an episode. The goal for this episode is to learn more about Ancora's microcap investment strategy and demystify some of their microcap myths. Thank you again for tuning in to episode 47 of the Planet MicroCap Podcast. Please enjoy my interview with Denis Amato, but first, a word from our sponsor.
A comprehensive streaming of market data, research, and portfolio management application for you. QuoteStream is a real-time streaming quotes and research system designed for the day trader, retail investor, institutional investor, both new and old. QuoteStream offers low latency, tick-by-tick data, advanced charting, comprehensive technical analysis, news, and research. With no software to install and no servers to maintain, QuoteStream is the ideal solution for you. Go to stocknewsnow.com and start your free 7-day trial. Click the QuoteStream banner in the header or real-time quotes in the nav bar to get started building and managing your investments.
For this episode of the Planet MicroCap Podcast, I have Denis Amato on the program. He is the Managing Director, Microcap Equities for Ancora Advisors. Denis, welcome to the Planet MicroCap Podcast.
Thanks, Bob. Good afternoon to you.
Good afternoon to you as well, and wishing your Cavaliers over there in Cleveland all the best of luck tonight.
We'll take all the luck we can get.
That's for sure. So, as we do on the podcast at the very beginning, I want to start with your background. You know, what is it, and how'd you get into the investing business?
Bob, I started almost 50 years ago in the investment business by joining the trust department of a large Cleveland, Ohio bank, and I served there as a portfolio manager, research director, and eventually the chief investment officer of the trust department. And after 25 years, I left there to join a startup of a boutique investment advisory firm, which over the years is what has morphed into today's Ancora Advisors.
So then at what point in your career then, how did you get started investing in microcap stocks?
Well, pretty early in my career, it became very clear to me that if you were going to outperform the market, you had to do something different than what everyone else was doing. And to do that, it seemed to me you had to find some area of inefficiency because otherwise you were just going to follow the crowd and do what everyone else was doing and have very little chance of outperforming. And it became pretty obvious that one of the most inefficient sectors of the market was the small and micro-cap stocks. And we made an early foray into that area in the trust department by setting up a small cap regional company focus, which was called the Ohio Heartland portfolio, where we used our proximity to companies in our region to get what we hoped would be a research advantage And in order to have the research advantage, it made sense to focus on those that weren't followed by a lot of other research analysts, which naturally was the small and micro-cap stocks in our region.
So Dennis, then what is Ancora's microcap investment strategy?
Well, from a combination of historical evidence, along with my experience over the years, it's resulted in a strategy based on four main aspects. The first one is valuation. All the historical studies show that actually microcap value does much better than microcap growth. So we use a valuation criteria that is based a lot on traditional parameters such as price to book, PE, price to sales, but then we overlay it with an analysis that's based on what we call normalized return analysis, where we're trying to identify what a company's normalized return will be or should be, not what it's currently doing, which focuses us on undervalued situations that have the potential to recover. The second aspect is balance sheets. We think it's very important in the microcap sector to stay with very strong balance sheets, which gives a company time to correct the problem that's causing its undervaluation, and also gives us as portfolio managers the confidence to keep buying even if the stock is heading lower. Third pillar, if you will, is insider activity. We have found that if you focus on what the insiders are doing with microcaps, it gives you a much better picture as to what might be happening, because in small companies, the insiders really know what's going on. And finally, we look for a potential catalyst, that hopefully that shortens the time frame between your purchase and when it eventually works out.
So Dennis, just to quickly follow up on those points that you're looking for in your investment strategy, not to take it one by one, but there was one thing that you said that we haven't heard yet on the podcast, and that was the normalized. I forget exactly how you phrased it. What was that again?
Normalized return analysis. Basically, what we're doing is saying, hey, this company historically has earned, say, 15% return on equity. And the industry that it operates in tends to earn 15% or close to it. But right now it's only earning 8. So we feel our job is to go in and say, why is this company only earning 8? What will allow it to get back to normal? Because we think that in economics and in finance, there is a tendency for things to return to norm. And so our job as analysts to say, what would prevent it? What'll create as a catalyst? What'll get it back there? And obviously, if a company's going from 8% return back up to 15, you're getting not only accelerating and increasing earnings, but the market then tends to put a higher PE on it than it is currently as well. And that's what gives you the big upside.
So then when we're talking about catalysts, how do you quantify that? What are certain things that you look for when you're taking in that part of your analysis?
Well, it has to be what I call potential catalyst, because if it was an obvious catalyst, the market would put, and it would already be in there. But I would classify things like a change in management that we evaluate as being positive, a new product or a new strategy that they're implementing, something to say, hey, there's a reason to think that there could be some improvement coming.
Mm-hmm. So in a paper that you just recently published, not too long ago, in October 2014, called, and I quote, MicroCap Myths, you discuss, as the title states, MicroCap Myths. And before we get into some of the myths and get into a little dialogue on those, why do you think these myths exist?
Well, the myths exist primarily because there's so few analysts and investors that focus and look on this sector. And that very absence of people that focus on it is not only why there's myths surrounding it, but also why excess returns are available in this area.
Mm-hmm. I mean, I mean, I guess these are things that just must have persisted as a result of maybe like one bad incident, or maybe there's a couple things that happen. I mean, would you say it's something like that as well?
Well, it may be that in individual investors' minds, but I think in general, a lot of it's due to misperception in the financial press and the financial media, and they sort of promulgate these myths from time to time as well, and they're not familiar with the area. So it's just the kind of thing that gets enhanced by repetition, if you will, and people aren't critically thinking about it.
And you're probably stuck in the position where you have to do a lot of educating for people that are interested in giving and putting some money to work in your fund, right? I mean,
definitely, because if you can't convince people that microcaps is a promising area for outperformance, that doesn't matter how good we are if they don't even want to be in the area. So our first job is to dispel some of the myths, number one, and convince them based on not only historical evidence, but also the whole rationale surrounding it as to why the historical outperformance is likely to continue into the future.
Would you say that your frequency of education has been going up or down of late?
It's about the same.
Okay.
Almost everybody you talk to about it, you first have to start out with the basic microcap education, and once they get over that, it's much easier to make the sale.
Right. So with that, that's actually a perfect transition into addressing the first myth, and I think this is like the number one, as it was number one in the paper. And from your perspective, why are microcap stocks not the same as penny stocks? Why do you think this myth exists and always keeps coming up?
Well, again, I think a lot of it goes back to the financial press, but also the fact that most penny stocks are microcap, but most microcaps are not penny stocks, and people don't make that distinction. Penny stocks, in my mind, are often small startups. They're sort of fly-by-night companies. Used to be in the old days, those were the uranium companies or the new biotech companies with no product. On the other hand, there's many microcaps out there that are very substantial companies that have very long histories. And in some cases, we've got companies that have been around 50 years or more. And because we define microcap as those with capitalizations under 500 million, that defines microcaps, but a lot of our companies may have sales of $1 billion or more. In my mind, that's hardly fly-by-night. So people have to realize that capitalization comes about from both the number of shares and the price of the stock. And oftentimes it's the fact that the price of the stock has come so far down is what makes it a microcap, but that's also what makes it a very attractive future investment.
Yeah, I definitely, when it comes to this myth, the financial media and even just the media in general has really not done our space a lot of favors. I think Wolf of Wall Street is probably the exhibit A.
Yeah, it's the exciting thing to talk about. The stock is 10 cents and goes to zero, but that's out there. But that's not how we look at microcaps. We're looking at very sound companies, like I said, with good balance sheets, good histories. They just have a temporary problem that's caused their stock to fall into this microcap category.
Do you also think, like, in some ways it's somewhat of an advantage as well? I mean, the fact that, most people don't even look at microcaps because they think, oh, penny stocks, I'm not even going to bother, too much risk. For those who know where to look and know what they're doing, I mean, it's kind of like, it's like that hidden gem, so to speak. I don't know. What do you think about that?
Oh, absolutely. The fact that few people want to play in the sandbox is what gives us the opportunity. And it's not only because of what you said with regard to their misperception. Many of the large investment managers out there have so much money under management that they can't even think about investing in microcaps because, if you have 20 billion under management, why do you want to put a couple $100 million into microcap? It doesn't mean anything to you. So it leaves that sector open for those who have not only the tendency but the wherewithal to focus on this issue in this area.
Mm-hmm. Moving to the next myth that you address, this one I wanted to kind of clarify. What do you mean by the myth microcaps are a homogeneous group, and why is this not the case?
What we have found is most people, when they're talking about large caps, they'll talk about large cap value, large cap growth, even mid cap value, mid cap growth. But when you get to microcap, most people just seem to lump all microcaps together. And the big mistake they're making is the fact that there's a huge difference between microcap value and microcap growth. In fact, if you look at, there's a study done by Fama and French, which now covers over 53 years of history. And what they have found is that the smallest decile of capitalization, the returns of that smallest decile have ranged from 5.2% to 22.3%. The 5.2 is for those that are in the top decile of price to book. In other words, the most overvalued, which tend to be growth stocks. And the 22% is in the lowest decile of price to book, which obviously tend to be the value component. So, over 50 years, the difference between 5.2 compounded annually and 22 is huge. I mean, just absolutely huge. And so to lump everything together, you make a real big mistake. And again, maybe it's a difference between penny stocks and real companies, but we think by looking at microcap value, you're really playing in the sandbox that has offered the best long-run return over many, many decades.
So then, in your opinion, and I've asked this before, but I'm curious as to your thoughts on this. What is the difference then between microcap value and microcap growth?
Well, it's a valuation issue. The Fama French study broke it down by price to book, but that's not the only thing we look at. We look at PE, price to sales, price to book, cash flow, etc. But it's not too dissimilar from some other areas where growth has all the good positive things built into its price. So the only thing you can do is be disappointed on the negative side, whereas value stocks tend to have all the negatives built into their price. So any change tends to more be on the positive side, and that's where the future returns come in, and it's a psychological issue as well. Most people would rather be with things that quote unquote look good or feel good. They don't want to be invested in companies that are having problems. And so behavioral finance tells you when you can separate yourself from the crowd that everyone wants to be with the good-looking guy, if you will, you can put yourself into an area where you can have better returns. I always hearken back to the slogan, would you rather look good or make money?
Can't we do both? I don't know. No,
not in most markets.
That's funny. So this actually ties into the next myth that you address, saying, why or about exposure. You can achieve exposure to microcaps through small cap exposure. So to you, what are the reasons why exposure to microcaps cannot be achieved through small cap exposure?
Well, that's a great question. And what we found is particularly a lot of consultants tend to tell their clients, well, don't worry about the microcap area. You'll get exposed to that through our allocation to small caps. And all the studies we've seen, including some by Morningstar, have shown that most small cap managers have less than 5% of their portfolio in microcaps. So if you're a portfolio and you want to allocate 20% of your portfolio to small caps, that means 5% of 20% is 1%. You'll have 1% exposure to microcaps. And to me, that just doesn't seem like enough to really benefit from the historical and we think potentially future outperformance that this sector provides. So it's a mathematical thing. And the second aspect is, or the reason it exists, is that a lot of small cap managers are so big and have so much money under management. Again, they cannot allocate enough assets to microcap to make it worth their while. So they tend not to do it.
Right, and also if they have a client that is saying that they want exposure to microcaps, just to get the client to be like, yeah, no, you
got it.
You'll get it. It's fine. Don't worry about it. So also, why, according to the same paper, that and I quote, while passive indexing may work in the efficient large cap universe, it does not work well in the inefficiently followed and less liquid microcap arena. What's the reasoning behind this statement?
I guess it's sort of almost self-explanatory. It's the inefficiency aspect. The fact that so few analysts are following these companies gives you the potential to uncover things that aren't well known and built into the price. And just to give you a mathematical reference point, we've done a study on our portfolio, and on average, our stocks are followed by 1.6 analysts. In other words, somewhere between 1 and 2 analysts on average. Many of our stocks, we're the only one following it, at least in terms of analysts, Wall Street analysts. And that compares, just to give you a reference point, that compares to 44 analysts that follow Apple. So if you think you can out-analyze and outguess and outsmart 44 other highly paid, experienced analysts, as opposed to trying to outperform 1.6 analysts, I know which odds I'll take.
Mm-hmm. On this point too, this idea also, not just passive indexing, but passive investing. I don't know if there's a study out there, and maybe you've seen it and I haven't, but I mean, have you seen anything with regard to, people just passively, they'll put their money in like an ETF versus this individual stock picking, something that your fund, does, and I'd say, I do personally. Have you seen anything out there like that? Like which strategy tends to yield the most results?
Well, I think we've seen some studies that do show that a higher percentage of portfolios in the microcap area outperform the microcap index than large cap managers that might outperform, say, the S&P 500. Mm-hmm. So it doesn't guarantee that you're going to outperform, but I think it does indicate that there is a higher probability of outperforming the index in microcap, which leads to a strategy in some cases of indexing your large cap, but going active in the small and microcap space.
Right. And this might be a dumb question, but I'm going to ask it anyway. Why wouldn't some of these bigger funds that even who have some small cap exposure, why wouldn't they just take a couple $1 million that they have already under management and create a microcap fund? What's stopping them? Like why wouldn't they just create that exposure just at their fund as it is? What's stopping? I mean, you guys did it.
I think it goes back to if you're a certain size, it just isn't worth it to them, to the really big managers. We happen to be a size where we're large enough to be able to devote some resources to this area, but not so large that having an exposure to microcap isn't valuable to us. For example, through experience as well as some analysis, it's often the case that you can't really invest more than say 300 or 400 million into this sector, any one manager. Well, for us, that's a nice product. For a Goldman Sachs or one of the other big managers, they would fill that up in a day, and then what do we do next?
Right.
So that's part of it. And if you're too small, well, then you don't have the resources to do some independent research. So we think we're in the sweet spot of being large enough to be able to do a good job, but small enough that it's still meaningful to us.
Right. Moving on to there was actually another paper that you wrote regarding I'll ask it in the form of the question. So, do you think that microcap value investing is a good alternative to private equity, and if so, why?
The paper we wrote, we spent quite a bit of study on that, and what we found is that the historical returns on microcap have been quite similar to that of private equity, and in fact have very similar correlation to the large cap, say the S&P 500. But the difference is the microcap portfolio has significantly greater liquidity. As you know, if you go into private equity, you may be tied up for several years without being able to access your funds. So to us, it makes a lot of sense to at least think about allocating a portion of one's private equity allocation to microcap in order to get similar returns, but have a little more liquidity.
Mm-hmm. Yeah, I mean, this is one point that we've covered a little bit on the podcast, and it just kind of seems to lend itself, especially when you're talking some of the even smaller, almost Nano-Cap, range type companies.
Yeah, we tend to go from like say 25 million of capitalization up in order to make sure that we have 25 to 500 million is our sweet spot. Below that, we think your liquidity is somewhat limited. So we'll occasionally dip slightly below that if we just see a tremendous opportunity. But generally, we're staying with 25 million of capitalization and above. Not to say there aren't some good opportunities below that, but we do want to maintain our liquidity. And for that reason, in our funds, we don't like to get more than, say, 5% of a particular company stock, because that would limit your liquidity also. And that's really why you have a limit on how much you can invest in this area. If you get too much, you then have to have either too many stocks, in which case you become an index fund, or you have to have such big positions in individual securities that you lose your liquidity on the other end. Mm-hmm. So for that reason, our studies have shown somewhere between 300 and 400 million is where you can pretty much max out.
Mm-hmm. So just to go back to your strategy real quick, what would you say is like the number one thing that as a microcap investor we should be looking for? I know there's everything is important, but if you had to give a little bit of weight to one thing in particular, what would that be?
Well, I guess value, because that's where we think the biggest distinction lies in the microcap area between value and growth. But it's hard to stay with one, because we also find that balance sheet and financial strength is often overlooked by investors in the microcap, not recognizing how much more important it is for microcap than it is for the large companies. A large company, if they need some temporary funds, they go to their bank. The bank says, okay, here's a line of credit. Microcap companies sometimes don't have that luxury. They get into trouble, and if you don't have time to resolve it, it doesn't matter that you were right in the long run, because you're not going to be there to benefit from it. So we think balance sheet and value and balance sheet are probably the two biggest components that investors should always keep in mind with microcap.
So this leads into one of my favorite questions, and that has to do with what investing experience do you always go back to as the one that helped shape your microcap investing philosophy today?
I don't think there's really one. I think it's a cumulative type of thing. It's the experience that you get over the years, that you see what has worked. And my experience has shown to me that the kind of criteria we use have been the ones that work. And I get back to our normalized return approach, where we calculate what we think the company's value would be in a normal environment. And it's amazing how often when one of our stocks gets bought out, the price that a company is paying for it is very comparable or similar to what we've calculated as the normalized value, which tells us that we're looking at companies the way a real investor, a real company looks at it, not just playing what I used to call the bigger fool theory. I'll buy it and sell it to some other poor fool at a higher price. If you're buying something based on real underlying value, your odds are much, much better.
So just to follow up on that, and we may have touched on this already, but how do you? I mean, and this may be proprietary as well, but if possible, like how does the firm calculate normalized value?
Well, again, we go back and look at history and comparables to see what kind of return on equity should this business be able to earn. The theory being that either the forces of returning things to norm will occur, or if this company can't do it on their own, there's other companies out there that'll buy them and do it for them. So if you can identify what a company should earn in a normalized environment, it gives you a earnings objective, and you can go back and look at history and see what kind of a relative PE the market has placed on those earnings when they've been in normal times. And when you apply the normal PE to the normal earnings, it gives you a price objective. And it's so nice because that not only gives you an upside objective, but it gives you a sell target. Mm-hmm. Once the company starts getting towards that or exceeding that, it gives you an automatic sell signal. So it's a really good way of doing it without having to spend a lot of time, which we don't, trying to figure out what the company's next quarter earnings are. We think that's a fool's game. Nobody's really been very good at doing that over the years. So we take a longer term approach. And in fact, our typical holding tends to be between 2 and 4 years. Mm-hmm. And if you think about it, that makes sense, because if a company's having a problem, they don't turn it around in a quarter. It sometimes takes a year or two to turn the company around. And then it takes the market another year or two for the market's perception of that turnaround to get built into the stock price. Mm-hmm. So, a 2, 3, 4 year time frame makes sense from a fundamental standpoint, we think.
Right. So Dennis, what is your advice for new microcap investors? What should they be looking out for? What should they be doing?
Well, in addition to spending time on value and balance sheet, we have found that spending time on looking at the company's insider activity, both for supporting your buy decision, but also is giving you a warning flag. I mean, you may think the stock still looks okay, but if you start seeing 4, 5, 6 of the insiders doing heavy selling, that should be a warning flag. They know if there's something going on in the company. They know when they could sell out at a much higher price. It's much different than, say, a General Electric, where there's 300 vice presidents, and if you see 4 of them selling, how do you know what that means? In the microcap, you see 3 or 4 insiders selling. It's a much more powerful signal, we think, in the microcaps, both on the buy and the sell side.
Yeah, that's a big deal. That's usually when you see a couple of them in the microcaps, you're usually kind of like, huh.
Yeah, it's not always the case. I mean, sometimes they need money to buy a house, or there's always things that occur. But that's why we look for multiple sellers, or at least multiple times, and look at the size of the sale relative to their position.
Right.
And again, you got to blend it all together with where the stock is and what else you know about the company. But we think you ignore it at your peril.
Mm-hmm. Another topic actually that we just talked about in the last episode on the podcast, and that has to do with CEO compensation and stock ownership. What are your thoughts on that?
Well, all other things being equal, one of the things we'll look at is what is the incentive comp based on, and we like to see management's interest aligned with the shareholders, certainly. In terms of ownership, it's a fine line because you want some, again, to be aligned with the shareholders, you want some ownership, but if it gets too much, then it prevents the takeover possibility that I was suggesting before. If the company, doesn't turn themselves around, if they can fend everybody off because of their insider holdings, then one of your potential avenues for success is not there. So, we like some good, strong ownership, but not generally so big that it controls the company.
Right. So for you, it's all about incentives. You want to make sure those incentive packages are done smartly and really in line with the shareholder base.
Correct.
Got it. So Dennis, we're at that point now. We're just starting to finish up here. Where can my audience go and find more information about you and Ancora Advisors?
The best place is Ancora's website. It's www.ancora.net. And there's two sections in there. One called Institutional Strategies with a subheading for Ancora MicroCap. And then there's a mutual fund section because we do have a public mutual fund. So in the mutual fund section, there's also an Ancora MicroCap fund section. So that would be the best area to find all kinds of information.
For sure. Dennis, thank you again so much for joining me today on the Planet MicroCap podcast. And hey, I'm rooting for you. Let's see a game 7.
Right now we'll go for a game 5.
Yeah, right. Well, you enjoy game 4 and have a great rest of your weekend, sir.
Okay, thanks a lot, Bo.
Thank you. Thank you all for tuning in to the Planet MicroCap podcast, and thank you, Dennis, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap podcast where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@snnwire.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the MicroCap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap podcast. Have a great week, everyone.